right, Nick, you ready to kick this thing off?
I am.
All right, so thank you all for joining us today. We're going to talk about infinite banking concept. What is an IBC? And understanding that concept, and to kind of give you a background before we start, my name's Jim Oliver. I've been helping people build wealth for 32 years. And the first 15 years of my career, I kind of did it the traditional way. I was a full service financial planner, built my own firm, went out to get assets under management, thought this was the way to build a practice and help my clients, quote, retire at some point in time in their lives. And it hit me after a couple of corrections that maybe things weren't going exactly the way our clients thought that they should go, or we thought that it should go. And we looked at our platforms that we were using for our investments, and it said that the average rate of return was like 9.38%. And I thought, wow, that's really good. But then we did the math and we did the CAGR, the compound annual growth rate. So net of everything. And it was close to 4%, really close to 4%. Well, then we started, so the math didn't work. What our clients thought they were earning in the stock market isn't really what they were earning actual rate of return. There's a big difference between average rate of return and actual rate of return. And so started looking at our clients that really had a lot of wealth. What were they doing? How did they build their wealth? And it came down to two things: real estate and businesses. And I met a gentleman about that time named R. Nelson Nash, who was in his 70s at the time. And I went to a 10-hour seminar that he did, and he introduced me to infinite banking concept. And I really learned from the inventor of the infinite banking concept. And I followed him around to some of his other 10-hour meetings to the point where I knew where the jokes were and where he was going to take a sip of coffee. I mean, he had it down to a science, and I knew this seminar like the back of my hand, Nick. And that's kind of how we started. And just like anything else, well, if we're going to teach people how to do this, we have to do it ourselves. So my family and I, we started practicing infinite banking, and we started where we started, and we just grew it from there. And to this point, I've bought or started or bought into 14 different companies, a lot of real estate. I use it for all of my expenses for different businesses and our personal expenses, and it's changed our lives. And so that's one of the reasons that we're passionate about sharing this with the group tonight. And this is what we do every day, is share this with people, and we're excited to do it. Nick, how about you?
Well, I would just say that for the first 30 plus years of my life, I exchanged time for money. And that came to bite me about 10 years ago. I was flying airplanes around the world, got laid off in the last economic downturn, and that began my quest. I dabbled in owning real estate before that, trying to build some passive income. But it wasn't until I got, slapped with the downturn, lost my job, that kind of started the path for me. And 6-7 years ago, I was hanging with a guy. I said something obtuse about money. I'd been interviewing financial advisors, and I'd leave the meeting, and I'm like, something doesn't add up, but I don't know what it is. Can't put my finger on it. And he said something about me knowing what infinite banking is. And little did I know, picking up the book, Becoming Your Own Banker, would genuinely change my life. And getting to meet Nelson, spend time with him, and learn what the wealthy really do. There's a ton of noise. You're going to get bombarded with 5,000 plus ads a day, and every one of them is trying to get money to flow away from you. And once you see it, you can't unsee it. And you realize that we do have to break away. We call our podcast Breakaway Wealth, because we're showing people how to break away from the herd so you can actually create true wealth in your life financially. We can have wealth in all aspects of our life, but financial freedom to be able to do what you want to do when you want to do it only comes when we understand the techniques of the wealthy, and those aren't out in the open to people. We've seen a big transformation of that this last few years in the real estate world, where a lot of people are waking up. And what they're doing is they're financing things with a bank or they're paying cash. And you taking control of the banking function, what we're going to show you tonight, whether you're a business owner, a real estate investor, or just trying to figure out how to take the first step and breaking away, you're not there yet. We're gonna show you that tonight, and we've got it broken down in about 3 parts. We're gonna try to get through this in the next 53 minutes and respect your time, and we'll tell you how to get in touch with us after that if you want to learn more. So, without further ado, Jim, why don't you take it away?
Great. All right. Sounds good, Nick. Thank you. All right. This is our disclosure. We're going to talk about some tax things. We're going to talk about some legal things, but we're not giving you individual tax advice or legal advice because we're not licensed to do that. Now, here's a game that most of us have played, and it's the game of Monopoly, right? Well, the problem is that most people play Monopoly just to have fun. And in fact, if we were playing Monopoly tonight, Nick, we might look at whoever's got the most money on the side of the table and say, hey, that player's winning. But that's not how you win in Monopoly. And there's only one rule of Monopoly that matters, and it's 4 houses equal a hotel. Okay, now, if I get hotels on this corner of the board, Nick, or on this side of the board, or this side of the board, I'm going to take all the other players' properties and I'm going to bankrupt them because they're playing to have fun. I'm playing to win. Now, do you ever feel like that happens in real life? There are people out there that are playing the game of money and you don't even realize they're playing because they're playing on a different plane than you're on.
Yeah.
So that's one of the things we want to talk about tonight is how we can change the way that we play the real game of money and play it the way people that have a lot of money play it, right? Now, I love this quote. The great obstacle to discovering the shape of the earth, the continents, and the ocean was not ignorance, but the illusion of knowledge. What we think we're supposed to do with our money isn't exactly what we really should be doing with our money. The things that we're being told to do with our money benefits the IRS, Wall Street, and the banks. Now, I'm not anti-government or anything like that, other than I'm anti-government controlling my money when they don't know what the hell they're doing, okay? Now, another great quote is we cannot solve our problems with the same thinking we used when we created them. So it's not outperform, it's not find the next best Wall Street investment or put more money into a qualified government program like a qualified plan, i.e. 401k or an IRA. That's not the answer. We have to do things differently. And things have really changed, Nick, over the last 30 years.
Yeah.
Let's look at 1990. Prime rates were 10%. Today, they're actually lower. They've gone down a little bit from 3.25, right? When was the last time you got a prime loan, Nick?
I don't remember.
Nelson always used to say, no, I've never met anybody who's prime. So now in 1990, we had 45 million people over the age of 55. Today, 95. Life expectancy has gone up 11 years from 75 to 86. The highest marginal tax bracket has gone from 31 to 36. And this is the next one is big, okay? Is our deficit, the national debt has gone from 3 trillion, and this number after COVID is wrong. It was 23 trillion, but now who knows what it's going to be?
Yeah, it's moving by the minute right now.
Absolutely. So, you know, what's interesting is the other day, Nick, we were working with this family, and here was their balance sheet.
Okay.
Their income was $36,000 a year. Their expenses were $47,000, and their debt was over $230,000. Now, what recommendations would you make for this family, Nick?
They gotta do one of two things, if not both. Figure out a way to make more money and start slashing some expenses.
That's exactly right. There's only 2 ways out of this, right?
Yeah.
Or file bankruptcy. All right, so let me show you what family this was. There was a few zeros missing. their income is really 3.6 trillion. Their expenses 4.7 trillion, and their debt is over 23 trillion. This is the U.S. national budget. Now, what are they going to do, Nick?
I'm guessing, well, we talked about they have to raise their income.
So how does the government raise their income?
Well, I think it's really important to understand that is they raise their income by asking the IRS to collect more taxes.
The government is a parasite. They need a host. Who's the host?
We are.
We are. So that's where they get their revenue. Now, by the way, if you think, well, taxes are high enough already, this is the average maximum tax rate, 58.1. Taxes are on sale right now, Nick.
That's right.
Now, look at back here in the 40s when it was over 90%. And by the way, the threshold back then was $200,000. If you made more than $200,000, you paid over 90% in income tax. Now, what's funny about that is that Ronald Reagan, who was a movie star at the time, he would only make two movies a year. And he got paid $100,000 per movie, because with California state tax and local taxes, he was at 100%. So any money that he made over $200,000, he didn't get to keep any. So don't think it's never happened before. Now, David Walker, he has a book that was in 2010, Nick, and it said, if significant fiscal reforms aren't enacted in the U.S., interest rates on the national debt will rise. The federal taxes could easily double from current levels by 2030. Wow, that's pretty bold, Nick. I mean, you think this guy knows what he's talking about? Who is he to make such a claim?
Yeah.
Well, he was the Comptroller General of the United States, he is the director of the Government Accountability Office. It's kind of a fancy way of saying he was the CPA for the United States. And he was in that position for over 10 years under President Clinton and President Bush. And he said the reason that they're going to double is math. So it's Medicare, Medicaid, Social Security, and the interest on the debt, which is one of the reasons that interest rates have stayed so low. Because if interest rates were in a normal environment, then we'd be really in trouble, right?
Yeah, it doesn't matter if you can print more money. You still have to pay the interest on the money that you're borrowing.
Exactly. Now, if we know that, then where are we going to store money? Well, okay, the first option is where it's taxed today, meaning we're taxed on gains, like in a savings account, money market account, CDs, non-qualified investment accounts like mutual funds, wrap accounts, anything outside of the qualified plan wrapper like a 401k or an IRA. Or we could be taxed tomorrow. 401ks, IRAs, SEPs, business equity, real estate, and annuities. Okay? At least here you have some deductions, right? Or what about this? Tax never. You're safe. And then when we use infinite banking, we use a specially designed life insurance contract, which we'll talk about a little bit more. But that's tax never. Once the money's in those two accounts, you never pay tax on it again. But there's a big difference, Nick, in savings, where it's guaranteed, where you're going to have guaranteed growth and you can't lose money, or the Las Vegas roll the dice of investing. Now, when I'm saying investing here, I'm talking about instruments, okay? Not assets, because I do believe you can do due diligence with real estate and businesses, and even loaning money, and you can make sure that you have the right collateral. And there really is, you can eliminate or greatly reduce the risk. Agreed?
Yep.
Okay, so if we were going to have a savings tool, the ideal savings tool, what would we want it to have? What attributes would it have? Well, one would be a competitive rate of return. Two is we want it to be guaranteed, right? We don't want to we don't want to take risk. We want it to be liquid, We want it to grow and have access tax-free. How about creditor protected? Absolutely, we want it to be creditor protected and uninterrupted compounding. Now, we're going to talk about uninterrupted compounding and give a great example of that in a few minutes, Nick, but obviously we don't want our compounding to be interrupted. If we understand the time value of money and compounding, interrupting it kills it. Okay, so how about your 401k and your IRA? How many of these 6 things do you get when you have a 401k or an IRA?
Couple, yeah.
2, competitive rate of return, potentially, and it's creditor protected. Okay, but what about the other things that we said we wanted? Could we get that in a savings account? Well, no, we get 2 things, guaranteed and liquid. It's not going to be competitive. It's not creditor protected. It's not tax-free. How about bonds and mutual funds? Again, 2, competitive rate of return. It doesn't grow tax-free. It's not creditor protected. It's not guaranteed, obviously, and it doesn't have uninterrupted compounding. But it is liquid and competitive, potentially competitive. All right, how about a specially designed life insurance contract? You get all of these things. Competitive rate of return, guaranteed growth, it's liquid, grows tax-free, and you have tax-free access, creditor protected, and you have uninterrupted compounding. That's the ideal savings. Now, we're going to use the ideal savings tool as our money pool to do some other things. Now, back to David Walker for just a minute. Here's a quote of his, that he has a significant portion of his retirement savings to purchase products from financially strong insurance companies. Okay, so if I know that this stuff is happening with my taxes and everything else, Nick, what do I do next?
Well, I think you got to decide, which one of these lines you're going to stand in. Because here's what's happening, everyone. There's really 2 movies playing right now. And there's really the movie of the reassuring lie. And that's where most people are standing, and you see our kid there, people are teaching their kids the same messages over and over. But really where the truth is over there. And sometimes it can look pretty lonely. And we go see an Inconvenient Truth movie. But what does it take to get out of that line? Because most people don't want to go be a lone ranger, right? Well, it takes a couple things. It takes, courage, conviction, confidence. And the last thing really is what we do, and we do a little coaching. You just need a guide, because this is about becoming your own banker. It's not, hey, Nick, Jim, take care of my money and make it grow. This is about you being empowered, because what the noise is telling you to do, the reassuring lie is that you're not smart enough to do this. So I want to make a prospectus that's got 100 pages in it, 99 and a half of them you can't understand. So you gloss over and you say, okay, here, just take control of my money. But it's costing you deeply. And so by partnering with someone that can show you where the doors are to go look at, can allow you to get into the real movie line of An Inconvenient Truth. So let's just talk about the couple principles, because becoming your own banker is actually really simple. And Einstein said simplicity is elusive. So let's just kind of dig in here and see how simple this is. Nelson said in his book, Becoming Your Own Banker, you finance everything you buy. You either pay interest to someone else or you give up interest you could have earned somewhere else. There are no exceptions. So let's look at this. All right. So it's really the amount of interest paid in each payment over the lifetime of the loan that matters. It's not the rate. If you think it's the rate, then you must believe that there is such thing as 0% interest when you go buy a car. It is really just a complete distraction. What matters is the volume of interest. Okay, so here's a little thing to help you remember. So you go get a shot at the doctor. It's not the rate or how fast they inject you that matters. It's the amount of medicine in the syringe. Too much might kill you. Not enough won't do anything for you. So you can kind of remember that little analogy, the mean guy standing there with the syringe. All right. So what's the other part? Now the financial entertainers, they love to ignore the fact that cash has a cost. All right. And we're going to show you an example, a couple examples. But when you pay cash, and listen, before my transformation and understanding this, I had done some, so I gotten some financial peace and was convinced that paying cash was the way to go. But when we do that, you give up interest or investment returns you could have earned somewhere else, even if you pay cash. That is lost opportunity cost. So let's look at an example of this. So anybody that's read Darren Hardy's book, The Compound Effect, knows that we borrowed this from him. But this is really just a penny doubling every day. It's getting 100% compounding, and we know that you can't do that readily out there. But look, the first couple weeks, it's really, really boring, okay? We get moving. Now we're starting to kind of get to something that might get your attention. But then we get to day 22. Now, I'm going to use a round number of $21,000 here. Now, you've saved up money in your savings account. You're going to go pay cash for a car. You're going to do what the financial entertainers told you to do, and you're going to do that. Now, what happens there, Jim? What happens on day 23 when we do that?
Well, you start over.
Start over. All right. Now, one penny annoys the bejesus out of me. All right. But after 31 days total, I got $2.56. That does not make me happy. So there's a couple of you out there that are going to argue with this if I just told you the number. So that's why we have the visual. I've had people pick up their phone and do this right in front of me. But on day 31, if we do not interrupt our compounding and that penny continues to double, I have $10.7 million. Now, my kids know if you hire them, they're going to try to hit you up for getting paid a penny doubling every day when they're over picking weeds at your house, but they've seen this. So, but that is the power of uninterrupted compounding of your money. So let's look a little bit further. What is IBC? Well, it's just how do we create our own banking system so that you profit from the bank instead of someone else. Now, if we're going to do that, if we're going to be able to do that, then we have to understand how banks make money. And this is to Jim's point. There's people playing the game so well that we don't even realize there's a game going on. And so let's dig in because the game's really not that complicated. Okay, so if we're going to understand how banks make money, if we're going to implement the same tactics that the bank uses, well, then we got to understand how they work. So let's kind of dig in here. I'm just going to show you a little brief overview of what's going on here. All right, so it's really simple. Einstein told us simplicity is elusive. And so let's try to dig into that and make this as simple as we can, because what happens is in the financial world, we try to make things so complicated that we gloss over and we just give over control. And what we've already been talking about is that's costing you a lot and it's not necessarily in your favor. If you have any argument whatsoever about that, just open one of those prospectuses that come to your house about the fund that you're in. And it's 100 pages and, it's like 4 font. Like you just gloss over, you give up. Good luck figuring out all the fees in that thing. So let's just dig in here and look at this. So we go down, we deposit money at the bank. Now, Jim, we ask people all the time, when you make a deposit in the bank, is that an asset or a liability to the bank? And they always say, that's an asset. Well, that's our consumer brain thinking. That's what we've been taught to think. All right. Remember, we don't really give good financial education in this world. So that's what we expect. Only the CPAs generally, or the people that have read ahead of us, know that that's actually a liability to the bank. The bank has to do something to turn that into an asset. And the loan itself is the asset. So if we were thinking about buying a bank, we would have to go down and we would want to evaluate their loan portfolio. That's what really matters. Okay. So now the borrower pays the bank back on that loan. And what's the bank do? It pays the depositor a little bit of scratch, right? That little bit of interest that they promise us. Okay. Now, listen, we've been talking about the seen and the unseen a little bit, right? Now, this is the scene about money in the bank. We all know this is going on, and this doesn't seem confusing to us. And it's certainly the way that it's billed to us doesn't come across as a problem. But let's just look at a number. Let's look at if we deposit $10,000. Now, I think it's safe to say that everyone here is at least annually depositing $10,000. Now, hopefully you're able to do that daily or better. All right. And we have clients that are putting a few $100s a month into their systems. And we have clients that are literally putting millions of dollars a year through their system. All right. This works for everyone. So let's look. The depositor gets paid in this example 0.2%. Now we know that that's even worse right now, but I'm going to show you why I'm using these numbers here briefly. So the depositor gets paid $20 on his $10,000 deposit in interest. And the bank turns around and sells that for anywhere from 3% to 28%. If you think 28% is crazy, just look at the fine print on your credit card statement. What happens if you don't pay? All right. Well, that's $520. Now, we have to look at this. And some people may not even think that this is necessarily a problem, okay? Because they're having their needs met, apparently. Now, how much better did the bank do than the customer, the depositor, did in this deal? Well, a lot of people would say $500. And again, that's the consumer brain. And remember, we're trying to become our own banker. And bankers are business owners, all right? And it's not complicated, all right? But look, 20 goes into 520 26 times. The bank did 2,600% more than you. But there's more to it. They did it with your money. That's the problem. The bank has no money in this deal. Okay? So that should clue us that maybe there's a way that we can do this too. And remember, I told you this is simple, okay? And simplicity, again, it's trying to make you think about this more complicated, but here it is right here. The depositor, the owner, and the borrower. And infinite banking is just about putting a wall around all three of those. Because right now, I would be willing to guess, unless you're one of our current clients, that you're 1 in 3. And remember, number 2 is who made all the money in this deal. Now you might be thinking to yourself, hey, this is crazy. These numbers, 2,600%, no way that's true. And in reality, I didn't really believe it either. There's a problem. These are Bank of America's numbers from 2016. All right. Now we just haven't updated, bought the reports and whatnot. But are you willing to bet that these numbers are actually worse now for the bank? No, they're frankly probably starting to get a little bit better. Okay, so let's just look at this, if we need to, a little bit deeper. We'll look at Bauer Financial. They analyze banks and credit unions. I love how they say this very carefully. All right, so this is from Bank of America, North Carolina. There it is, 2016. And here's the fine print in that report. Their interest-bearing deposits were $860 billion. Okay, now their interest income, what they earned, was $44.7 billion. Okay, we see that down here. And what they had to pay us was only $1.9 billion. Well, we look at that ratio. We have a 26 to 1 ratio in all of this. They collected over 44 billion. They paid out 1.9 billion in interest. And that right there is how the banks make money. All right, so let's look at another example at how banks make money. All right. So we're going to look at a mortgage. All right. Now I know the mortgage prices are starting to creep up, but this is kind of sets it in the middle. So we got a mortgage of $300,000. We're going to borrow at 5%, which we know is a fuzz high right now, but you never can time interest rates. You just don't know what they're going to wind up being. So this is for 360 months, 30-year mortgage. It's just a payment calculator that you can get online. All right, it's very simple. We're not making this up. It's $1,610.46. Now, if I take that 1610.46 and multiply it times 360 payments, that comes out to $579,000. Now, Jim, where the heck did the 5% come from in that? That's almost double what I signed up when I borrowed the money. So here's the thing. That's really 48 cents of every dollar going to someone else in interest. So think about it. Go back to what I said, that this is not about the rate, it's about the volume, okay? So Jim, if you earn $1 and you have to give me half of it, do you care what the rate is?
No, I just want to know, how come I have to give you half my money? You sound like the IRS.
Well, you're bigger than I am, but I am faster, so it depends on who's got the money in their hands. But here's the problem is in the first few years, the average mortgage is around 5 years. But here's the thing. In those first few years, it's north of 80 cents of every dollar goes to someone else in interest. That's insane. So what happens, Jim, when we have a mortgage that's 4, 5, 6 years old? I mean, I'm getting emails. I'm getting bombarded right now. My mortgage here at home is only 2 years old. What do they want to do?
They want to start your amortization all over again.
Yeah, just look at the amortization sheet and look how much of the first payment goes to interest. And then look how much the 180th payment goes to interest. It's about the volume of interest you're paying someone else. Okay, but there's another little trick going on here, and it's actually if you can apply this in your real life, this is the one that will really propel you to another level. So every time that the bank gets that 1610 payment from us, Jim, I got a feeling they take it home and they sit by a warm fire with it, right?
Actually, the bank is brutal. They know what to do with money. They loan it back out as fast as they can.
In a fraction of a second. That's why they're out there hounding you to have your deposits at the bank and then selling the money over and over, right? So they do it in a fraction of a second. So here's all we're going to do. We're going to take and we're going to put that the bank's going to earn 5% again on every payment going in. And this is just one time, right? It's just each payment is going to be lent out one time. So this 579,000 is going to turn into 1.3 million. That's how the bank looks at that one loan. And you do this with credit cards, your head will kind of pop off a little bit because you don't get, Samuel L. Jackson and Jennifer Garner on prime time night after night if you're not printing money, essentially. So it's a huge delta. And what we call this is velocity of money. And so you'll hear us get excited talking about velocity of money and redeploying capital.
Yeah, and think about it, Nick. What they do is they take your mortgage payment, my mortgage payment, but they bundle it together, loan it back out, and this is just for 30 years. They're going to take that money, loan it out back out every time you make a payment one more time for the duration of this loan and the same terms as this loan, just like another mortgage. But just if they were doing credit cards or anything else, they would make a lot more than $1 million on a $300,000 loan. But think about it. A $300,000 loan, they're going to make $1 million by loaning it out one more time. But they're going to loan it out over and over and over and over and over again.
Yeah, and once, as Nelson so eloquently puts it, because he was so eloquent with his words, if you know what's happening, you'll know what to do. So, all right. So let's just look at your IBC business, because remember, we're just starting a simple business. All right. And like any business, there's a little bit of cost, but guess what? We want our business to be profitable, and we can show you how to make it profitable. All right. The first year, we're just going to use some round numbers of putting $100,000 into your banking business in year one. Now you get $60,000 to use. You can pull that back out in year one. Now, that's a really good first year, almost no matter what business we're looking at, because almost no one breaks even in year one. There are some exceptions to that, but almost no one. All right. So year two, we put in 100,000. Hey, we're breaking even in year two. Business is looking good. We did something right. We set up the business the proper way in year one. I like that. So year three, we put in 100,000. Now we're turning a little profit. I get $101,000 out of that. All right. And year four, it's getting better and better. I put in 100, I get 102 to use. Now there's something that we talked about earlier about this compound interest and what's happening. And I want to just remind you of that. It looked a little boring at the beginning, but it gets a heck of a lot better looking as we go. So just as an example, at year 10, I put in 100 and I get 150,000 more to use. Now that's beating the heck out of my checking account here in town. I don't know about you, Jim, but
well, Nick, is there ever a time that you put $100,000 in your checking account and the bank says, you've been doing this for 10 years. We're going to go ahead and let you have 150 to spend.
That's so kind of them, but no, they don't do that.
They don't do that. I'm 55, and I've never seen, nobody's ever made that offer to me. Not even $101 would they, I mean, they're not giving me $1 for free.
So Jim, if we get to this point and you write me a check for 100,000, I turn around and give you a check for 150,000. How often do you want to do that?
Every day, all day.
And how big of a check are you going to write? Well, if we can do that.
How big would you let me write one?
So it's fun at this point. All right. So that's our business. And honestly, I don't care what the business is. If we're evaluating a business and this is what it's going to look like, I'm really interested. Actually, I really don't even care what the sign says. I'm probably beyond that part in the conversation. So let's just look at this. All right. Let's put this in motion, because what the velocity piece, the loan, remember, we got to lend this money out. It can be to ourselves, or it can be to our businesses. It can be to whatever we want it to be, but we got to put it in motion. That's how we win. So I got 100,000. I put in, I got 60 to deploy. I've got a loan out there. We'll call it an equipment loan that I'm paying $5,000 a month on. And I got a $60,000 balance. I'm going to pay that thing off. I'm going to stop paying interest to someone else, because that's a problem. I redirect those monthly payments back to myself. And at the end of the year, I got 60 to use again. I'm going to put another 100,000 into my business. Remember, we get 100,000 to use, plus I get the 60 to use again. So I have $160,000 to deploy. There's that ugly 3-letter word. We have a tax bill. All right, let's say it's 160,000, and I'm planning on paying $13,333 a month. All right, I redirect that back to myself. I pay that thing off. I'm not on my payment plan with the IRS anymore, and I pay that back. At the end of the year, I've recaptured all of those dollars back to myself. Year 3, I put in 100. Remember, it's going to go up 101. Plus, I get my 160, because this is building. I get 261,000 to take and deploy for something. We see a lot of $1 million real estate investments now. Some of these dollars are getting larger and larger. And I like to joke with Javi, do you want to draw the small deal cards or the big deal cards? So we're starting to get, let's do a big deal, all right, a bigger deal. So we put 261,000 down on $1 million real estate investment. And we've evaluated this, and we're going to get $2,500 a month in cash flow. Now we're starting to talk about something else here. Remember, we want to do what the wealthy are doing, and they create passive income that meets or exceeds their ideal standard of living. All right? So check this out. I've deployed that capital. It's coming back to myself, and I have 30,000 of cash flow. That's money that comes to you whether you get out of bed or not. Year 4, I put in 100. It's going to go up 102. I've got the 30 that I recaptured from my real estate investment. So I got $132,000 to go take down another deal with. So it just keeps building. It's just like the penny doubling. All right, so let's look at this. In the first 37 months, this is really, really cool. Your investment, you've put $400,000 into your banking business, okay? You've capitalized $400,000 into it, okay? And it's not for naught. All right, you've paid off $220,000 of debt. Remember, you had the equipment loan, and we had IRS bill to pay. All right, that's pretty cool. We've paid that off. But wait a second. I've got $363,000 of cash value in my policy, and it's growing uninterrupted for me while I'm using this. Now I'm starting to really build my financial statement. I got $1 million of real estate owned and $30,000 of passive income. You are being a banker. You are building wealth, and you're building this freedom in your life, this stress-free life by being your own banker. All right. It's as simple as this. You write the checks to the bank instead of to someone else. And the continued use of this system will create an ever-increasing pool of money for you, your family, and your business. And there's only one product in the world that will do what I'm telling you it needs to do, and it's a specifically designed dividend-paying whole life insurance contract. This is not the ones that most people have bought in their lives. So let's just look at this because there's some nuances to this, and there's a video on our YouTube channel. It's called the 10-minute lesson in life insurance, and it'll really take your knowledge set really high. But there's two types of insurance companies. There's a stock company and a mutual company. Okay. Now, 100% of the profits are paid to the owners of the companies, of these two types of companies. Now, the shareholders own the stock company. But guess who owns the mutual company? We do, the policy owners. All right. So when the business is profitable, guess what? We get to share in that part too. All right. Let's look at a couple other people that have actually done this. Because remember, we talked about breaking away from the herd, right? We talked about, hey, the people that have done the uncommon, this is what they do. So Ray Kroc, most people think McDonald's is about hamburgers. It's really about real estate. All right. But he didn't take a salary in his first 8 years. And to overcome constant cash flow problems, he just borrowed money against 2 life insurance policies to help cover the salaries of his key employees. And then Disney, old Walt, was having trouble getting financing. All right. And he had a dream. He wanted this thing to happen. And so he borrowed most of the money to start Walt Disney came from borrowing from cash value life insurance. Now, nobody get upset, all right, because there's people on this screen that make people, twitch a little bit right now. And it doesn't matter who you like, all right. We got them all covered. The guys on the left there, they used to do this. They knew about this. And the guys on the right, both of those guys do this. And I always like knowing this right here. There's also 54 current elected officials doing this because we get asked a lot, hey, well, won't this go away? Well, the guys writing the rules do this. And then the guys who are paying for all the lobbyists, every Fortune 500 company does this. They're helping the rules be made. They've figured out how to leverage this tool. So I always just like, hey, I want to be with those people. I always I don't know where we heard this recently, Jim, but it said only the dead fish go with the flow.
That's right.
That's the herd. Okay. I like kind of trying to figure out what these guys are doing. But guess what? Wait a second. We've been kind of talking bad about the banks, Jim, but these banks do this too.
Said they were stupid.
Yeah, look, Wells Fargo only has $21.3 billion of cash value in their policies. Bank of America, just over $20 billion. They have something called bank-owned life insurance, BOLI. The corporations have something called COLI, corporate-owned life insurance. And so they store a decent chunk of their money. They're actually only allowed to store 25% of their tier 1 assets into these particular types of policies, but they're buying the same thing we are. All right, Jim.
If you let me, I think I can share my screen.
So Jim's going to do here for you. He's just going to kind of bring this all together and kind of show you the flow of the money and draw this out really like no one else can.
All right, Nick, hopefully we are, I don't even want to tell the audience. I have an iMac Pro, supposed to be just, it should not have any problems. So I just want to just make that clear. Okay, so if there's any accounting majors or CPAs out there, I'm going to call this a ledger, and I know that it's backwards. So, if you put in the comments, hey, your ledger's backwards, I get it. But this is just the way that I explain this dance of infinite banking, and I hope that it helps you put it all together. Okay, so we have this policy, right? And the policy is designed for cash value. Now, it still has death benefit, long-term care benefits and things, terminal illness stuff. And it qualifies as life insurance, which is really important because there's a lot of tax advantages to life insurance. And that's why people that really have a lot of money buy it. Okay. But the type of life insurance that we use, it grows every day uninterrupted. Now, Nick, I'm not going to say like the penny because it doesn't grow that fast. If it did, then we'd have a line out our door that we would keep open 24 hours a day. Okay, but it doesn't grow like that, but it grows uninterrupted. And remember, like Nick said, we're going to buy this policy from a mutual insurance company, which means we're an owner of that company. And we have certain contractual rights as policyholders of that company. One of them is that we get to take an interest-only loan from the insurance company. All right. Now, this is something that 95% of insurance agents or professionals don't know. When you take a loan from this type of policy, your money doesn't go anywhere. All they do is put a lien on your cash value, and they have to give you their money. All right. Now, Nick, I have other people's money, right? OPM.
Love it.
I have use and control of that money. I want to be my own bank. I want to be the banker, right? So I'm going to take their money, interest only. Now, Nick, an interest only loan is unstructured. There's no payments or anything else. This is kind of and play along with this, Nick, like this is the first time you heard it. But let's say I would loan you $100 million today.
Okay.
And your only obligation is in 1 year, you have to pay me $5 million of interest. That's it. Would you take the loan?
All right. Makes me a little nervous to think of it. Like, that's a big number, but I do think that I know what to do with the money. So I'll take it. I'll take the chance. I'm a gambler.
All right. Well, I wouldn't see it as gambling. I'd see it as being a smart business person. But let's turn it around. Let's say that you made me that offer. By the way, if you have $100 million, I'll take it because I know what to do with it. So here's what I'm going to do. Okay. You made me that offer. I'm going to take your $100 million. I'm going to go to the bank and I'm going to bet that I can get 80% loan to value when I got $100 million of cash. Right. And so I'm going to borrow $400 million from them, take your $100 million, and I'm going to buy $500 million of real estate. Okay. Now, before I pay you, I'm going to net just 5% on that $500 million. That means I'm going to collect $25 million. I'm going to call you up you're not going to have to hunt me down, Nick. I'm going to call you in a year and I'm going to say, Nick, I got your check for $5 million, bud. And in fact, I want to buy you lunch. I appreciate it so much. Right? Write you a check for $5 million. I keep 20 and you say, hey, do you want to pay any principal? And I say, no, I don't think so. See you next year. And I'll do that all right. So that's how this interest only loan works. So now I'm going to take it and I like to invest in real estate. So I'm going to start off in real estate. Okay. I'm going to buy some real estate. It's going to cash flow. So I'm going to flow that cash back to me as the banker. And then I decide if any principal is paid back. If I pay back any principal, every dollar that I do, again, I decide it reduces my lien by how much I pay them, and it increases my net cash value. Well, what did the bank do when they got payments in?
They deployed it again.
They loaned it back out. So let's say this time I'm going to buy a car, and I normally would pay interest or lost opportunity costs because I was listening at the beginning and you talked about that. Well, that money would have gone to somebody else. But now I'm going to recapture those dollars and I'm going to flow those payments back to me. Again, if I decide to pay any money back, which I would on a car because I would pay it back whatever way the dealership was going to charge me. But then, you know what? I found this other real estate deal and I'm going to borrow money out again, the same money that I have created cash flow here, kind of what you did earlier in your explanation. I'm going to borrow the money, buy the real estate. It's going to cash flow. I'm going to flow that back through my bank, and I'm just going to keep on doing it over and over and over again. Now, that's pretty cool, right? But here's something that's really special. Because I'm collateralizing this and my money never leaves this life insurance contract, I get whatever my life insurance contract is doing. And now there are guys on YouTube right now that put out videos and they don't understand this. They focus on the policy over and over and over again and how to design the policy. They're even wrong about that. But what they don't talk about is my asset activity. My asset activity is the biggest thing because my ROR over here is going to be big. I'm going to use the money. I'm going to create velocity of money. I'm going to do all of these things. And you know what the best part of all this is, Nick? I get both.
You got no money in the deal. Oh, yeah.
I got no money in the deal, right? I'm going to go buy with the insurance company's money, not mine. But I get both. I get what's happening in the insurance contract, and I get what's happening with my asset activity. All right. I get both. Now tell me another vehicle where I get both.
No, because we
I'm
always
in
have to
control.
choose. Yeah.
Nick, you know what I have to do? What kind of approval process there is for this loan?
Um,
Zero.
we don't even apply for it.
No. You call Kelly, our office manager. She helps you apply for, or not apply, order the loan. You don't have to tell them what it's for. You don't have to tell them that when you're going to pay it back. They're not going to ask you anything. In fact, they don't even care if you set up a promissory note to pay it back.
No.
Right? So you're in control. Now somebody's going to be the banker in your life, and whoever controls the money makes the money. Okay? We know that. And if you know what to do with the money, and by the way, if you don't know what to do with the money, listen to our podcast. We're not recommending any of the guests, but they all have like different ideas and different things that they've done. Maybe you could mirror somebody. There are people that are doing passive investment opportunities. There are a lot of different things. And Nelson says in his book, Becoming Your Own Banker, Nick, he says, imagination is the number one thing when you're figuring this out, because this is what it's all about. Where am I going to use my money? Well, it's only limited by my imagination. Now,
Yeah.
I know that you can see that there's a reason why I didn't go to school to become a graphic artist, but hopefully this little play that I've drawn out makes sense. Anything to add to that, Nick?
No, it's perfect. It's about opening our mind to a better way of life, and I love what you just said, something about people meeting the people that are on our podcast. Sometimes we have, guys that are professionals. Other times we have our clients on there, and we're seeing a lot of clients getting introductions to each other and working deals with each other, and the chat groups that have started. We're both in numerous bulk chats of clients. Learning from each other, because you got to start somewhere.
Absolutely. And the thing is that you said this earlier, is we're not the hero of this story. We're not calling you or doing this webinar and saying, here's how great Create Tailwind is. We're the guides, just like if you've looked at Story Brand, is, we're Yoda. We're not Luke. You get to be Luke in your story, right? You get to be the hero in your story. And we just want to help guide you, because this is what we've done. And if you can't tell, we're passionate about it. Now, there are certain things that you have to have. You have to have that specially designed dividend paying whole life insurance policy designed the right way. With a mutual insurance company, we want to be owners. We want it to be 100 years old or older, strong financials versus ratings. AIG had all of the top ratings, Nick, 30 days before they were insolvent back in 2008. And their derivatives division almost brought them down. But they had the top ratings.
Yeah.
And they didn't know about the derivatives division. That's crazy. And some of these insurance companies don't like infinite banking. So we want a company that does. We're not tied to any one insurance company. We can write business. They all want our business, because they know what we show people how to do works. It's got to be designed for the highest cash value possible. Strong guaranteed values. These are all things that you have to have, and we can show you how to do that. And we got to make sure that it never becomes a modified endowment contract. And one of the things that people are on YouTube talking about is putting these large term riders on there, and they don't talk about the dangers and some of the things that can happen with the term rider, and how it can make your policy a MEC. And a MEC, a modified endowment contract, audience, acts like a qualified plan. All the same penalties, rules, everything else. So we also have to make sure that the dividends are buying paid up additions. But these are just some of the things that go into designing the policies. Now, we've been doing this for our families and our clients for over 15 years. In fact, really 32 years in designing the right types of insurance contracts. Nelson used to say, this concept is very simple. Don't complicate it. But if you're listening to this for the first time and you haven't heard about infinite banking, it's a paradigm shift. It's a mindset change. And just know it takes some time. And we will spend as much time with our clients that we need to. And if you're interested in becoming a client, there's a lot of things that you can do. But Nick, what's the easiest way to get a hold of us?
All right. So just a couple things. You're going to get a thank you email for being on here today. A lot of you have asked about a recording. There's going to be a recording link that will eventually be uploaded to our YouTube channel. But whoever invited you to come here, one of the other agents here or our office manager, if they invited you to come here, get in touch with them. Schedule a time to get your questions answered. Also, there's going to be a scheduling link to schedule a 20-minute call with me where we can start the process of unpacking your questions for you, show you what we do. I promise you there's never any, wrangle you on the ground and hard close. It's not how we operate. We just want to work with people that want to learn. And what'll happen is at some point you'll decide whether this is for you or not for you. And it's a very simple process, like Nelson said. And just know there's a lot of noise about infinite banking on the internet. It used to be really just Nelson and a couple others. And through the power of social media, there's a lot of things out there that are probably not advisable to do. That are going to have the long-term benefits. And Jim and I ask people all the time, do you want to start first or finish first? And to do this right, it may not look like you're starting first, but I can tell you in our lives, we feel like we're getting close to finishing first, and we can't promise that to anybody, but we're having a lot of fun doing that. So we just want to thank everyone for coming on here. We try to respect your time, appreciate all the grace through our little IT glitch, but I think it's all well, and thanks a bunch.
Yeah, thank you, Nick. Thank you, audience. Look forward to talking to you and help coach you to financial freedom. And Nick, thanks for your time.
Likewise.
Until next time. Thank you.